RBC, the Royal Bank of Canada, is not just Canada's largest bank. It's one of the most important financial institutions in North America. With a rich history, a wide economic moat, and a reputation for resilience, RBC has long been a favourite among conservative long-term investors. But does it still make sense to invest in RBC in today's uncertain economic environment? In this video, we're going to break it all down. The business model, financials, technical analysis, market risks, and a final buy recommendation. Whether you're a seasoned investor or just getting started, this is your complete RBC deep dive. Let's begin with what RBC actually does and why its business model is built for stability. RBC operates through 5 primary business segments, each of which contributes to the company's strength in different ways. The personal and commercial banking segment is the foundation. It covers everyday banking services like savings accounts, mortgages, personal loans, and credit cards. RBC has a dominant position in the Canadian retail banking space with more than 17 million clients across the country. The stickiness of these customer relationships is huge. Most Canadians bank with RBC or one of the other big 6 from a young age, and many stick with them for life. That kind of customer loyalty is a competitive advantage most companies would kill for. Next is wealth management. This is where RBC really starts to differentiate itself from the pack. The bank manages over $1 trillion in client assets, largely through its RBC Dominion Securities arm and its US operations under City National Bank. As demographics shift and more Canadians enter retirement, demand for wealth planning and asset management is only going to grow. RBC is well positioned to capture that growth. Wealth management also tends to be more fee-based, which means it's less sensitive to interest rate swings and more resilient during market volatility. Then there's capital markets, which includes investment banking, trading, and advisory services. RBC Capital Markets is a major player not only in Canada, but also globally, with offices in major financial centres like New York, London, and Hong Kong. This segment brings in significant profits, especially during times of market activity, but it's also more volatile than the rest of the business. Still, when markets are hot and IPOs, M&A deals, and bond issuances are flowing, capital markets helps drive growth in a big way. The other 2 segments, insurance and investor and treasury services, round out the portfolio. Insurance provides life, health, home, and auto policies, and it generates stable, recurring premiums. Investor and treasury services is more institutional, handling global custody, fund administration, and liquidity services for asset managers and pension funds. Combined, these segments make RBC a full-spectrum financial services company. Now, let's turn to the fundamentals from a financial standpoint. And RBC is a fortress. Its balance sheet is among the strongest in the banking world. The bank consistently maintains a Common Equity Tier 1 (CET1) ratio above 13%, well above the regulatory minimum. This gives it flexibility to withstand economic downturns, pay dividends, and even consider acquisitions. In the last fiscal year, RBC generated over $15 billion in net income. That's not just a reflection of strong performance. It's also a testament to the stability of the Canadian banking system. RBC's return on equity has consistently hovered between 14% and 17%, which is exceptional for a bank of its size. It shows that management is effectively using shareholder capital to generate profits. The bank's efficiency ratio, expenses as a percentage of revenue, usually sits around 45% to 50%, which means RBC runs a very lean operation. For comparison, many US banks operate with efficiency ratios above 60%. Another cornerstone of RBC's appeal is its dividend. This is a dividend aristocrat with a current yield of about 4.5% and a payout ratio around 45%. The bank has paid dividends for over 150 years. Yes, even during World Wars, the Great Depression, and the 2008 financial crisis. This is incredibly rare, and it's a key reason why RBC is so trusted among retirees and income-seeking investors. The dividend is not just safe, it's growing. RBC typically raises its dividend twice a year, depending on economic conditions. Over the past decade, the dividend has grown at a compound annual rate of about 7%. When you reinvest those dividends, the power of compounding starts to accelerate your returns. Now let's talk valuation. RBC usually trades at a slight premium to its Canadian peers, and that's justified. Its higher ROE, more diversified revenue base, and strong brand command that premium. Currently, the stock trades at around 11 to 12 times forward earnings. Historically, that's in line with its long-term average. On a price-to-book basis, it trades around 1.7 to 2.0 times book value, again higher than some of its peers. But that's reflective of better returns and greater capital efficiency. This isn't a value trap, it's a high-quality franchise being priced accordingly. Now let's pivot to the technical side. From a technical analysis standpoint, RBC's chart shows a long-term upward trend with cyclical corrections. The 200-day moving average has historically acted as strong support, and we're currently seeing the stock trading near the midpoint of its 52-week range. Key support levels lie around $110 SAD, with resistance around $130. If we break that $130 resistance level with strong volume, it could signal a new leg higher. The RSI, Relative Strength Index, is sitting in the 45 to 55 range, which tells us the stock is in neutral territory. It's neither overbought nor oversold. This gives investors a good entry point without chasing price momentum. Volume trends show institutional buying on dips, especially around dividend declaration periods, suggesting large investors are comfortable accumulating shares when the yield becomes especially attractive. These are all signals that technical support aligns well with the fundamental thesis. Now let's look at market risks. While RBC is a high-quality company, there are still risks. The first is interest rate risk. Rising rates generally help banks increase their net interest margins, but there's a limit. If rates rise too quickly or too high, it could slow the economy, increase default rates, and ultimately hurt the bank's loan book. Conversely, falling rates compress margins and reduce profitability. The second major risk is exposure to the Canadian housing market. RBC holds a substantial mortgage portfolio, and while most of it is insured or made up of prime borrowers, a deep correction in housing prices could increase delinquencies. Canadian household debt levels are among the highest in the world, and any trigger, like rising unemployment, could cause stress in the system. Regulatory risk is another factor. RBC operates under the oversight of OSFI in Canada and multiple regulators abroad. While Canada's banking sector is considered one of the safest, increased capital requirements or tighter rules could reduce profitability over time. Finally, competition from fintech and digital-only banks is real. RBC is investing heavily in digital transformation, but technology is advancing quickly. The bank will need to continue innovating to retain younger customers who expect seamless, mobile-first experiences. So with all of that said, is RBC a buy? Here's the case. RBC is a premium bank with a wide economic moat, strong capital, diversified revenue, and a management team with a long track record of delivering value to shareholders. You're getting a business that's highly profitable, highly defensive, and highly committed to returning capital to shareholders through dividends and buybacks. If you're a long-term investor seeking a core holding that you can buy and forget, RBC is a top-tier option. Especially if you're looking for dividend income, it offers a combination of stability and yield that's hard to find in today's market. For those looking to build a position, buying near or below $120 KD offers a solid entry point. You get a strong dividend yield, reasonable valuation, and upside potential as the bank continues to grow its wealth and capital markets divisions, particularly in the US. If you're younger and just starting out, RBC might not provide the explosive growth of a tech stock, but it gives you something arguably more important: consistency. With reinvested dividends and steady compounding, RBC can become a foundational piece of any long-term portfolio. And if you're nearing retirement or already living off income, RBC can serve as a reliable income generator that doesn't require you to constantly monitor it. It's a sleep well at night kind of stock. So, is it the flashiest stock on the market? No, but is it one of the most dependable? Absolutely. Thanks for watching. If you found this analysis helpful, hit that like button and subscribe for more deep dives into high-quality businesses. What's your take on RBC? Are you buying, holding, or watching from the sidelines? Let's get the conversation started in the comments. I'd love to hear your thoughts.